Good morning. This is Bloomberg Daybreak Europe. I'm Anna Edwards in London, and these are the stories that set your agenda. US stocks set for gains at the open as investors look for signs of optimism in trade relations. The UK market also reopens after a holiday yesterday. President Trump delays his 50% tariff on EU imports until July as the Commission says there's now a new impetus for trade negotiations. Plus, Germany's Chancellor gives Ukraine permission to use weapons to strike deep inside Russia, bringing it into line with the US and the UK. Good morning, everybody. This is Bloomberg Daybreak Europe, Tuesday morning. UK markets, US markets closed yesterday. So how does that set us up? Where does that leave us in terms of the global futures picture? Let's have a look at European futures then here and US futures. Of course, yesterday we saw a lot of Europe up and trading and having the chance to price in what we heard from President Trump, pulling away from Friday's shock suggestion of a 50% tariff on the EU. So pulling away from that, and the European Commission over the weekend and into yesterday continuing to suggest there's going to be more pace to these trade conversations, and so that got the market a little more excited, or at least a little less worried on the trade front. And so we saw things were pretty risk on in Europe yesterday. So that means that Europe could be confusing today because, of course, the UK was closed yesterday. So the UK plays catch up on that positive sentiment, but the rest of Europe perhaps treads water or perhaps goes a little weaker. In terms of the US futures picture, there again we see room to price in that trade optimism, and we see the futures picture suggesting that S&P futures and NASDAQ futures all trade higher. Really interesting things happening in Japan and in global bond markets, though. So let's have a quick look at some other assets that are in focus for us this morning. This is dollar yen. And actually earlier on, when we put this list together, we had a lot more strength coming through in the Japanese currency. But some of that has been dialed back as we've seen some really interesting movements in yields coming down at the longer end of the Japanese curve. But here we are right now, US dollar 142.95. We've heard from Governor Ueda. We'll talk more about what he's had to say, but essentially reinforcing a commitment to continue increasing rates if the economy develops as expected. US 30-year yield. In case you've taken a long weekend, Memorial Weekend, wondering whether there's anything you need to worry about at the long end of the curve, well, basically less than you were worried about on Thursday seems to be the short way to answer that. So 4.98. We're back on the US 30-year. We're back down below that 5% mark. Remember, we got to, 5.13, somewhere around then during Thursday's session. So a little bit less nervousness in markets around the US fiscal position, it would seem. The Japanese 20-year yield, we put this in here because it seems to be at this tenor that we're seeing quite a lot of movement, quite a lot of reaction. Yes, perhaps to some things that Governor Ueda has been saying, but also to what the Ministry of Finance is doing in the Japanese market, consulting with market participants there. There's been nervousness as the BOJ steps away from that market as to who's coming forward to buy. Well, they are asking questions on that front, and we see yields coming down as a result of that. Brent crude, 64.54, pretty stable on the Brent price, down by around 0.3% this morning. Now, Bank of Japan Governor Kazuo Ueda has given the yen a boost by indicating his intention to continue raising the benchmark interest rate if the economy improves as expected.
To the extent that incoming data allows us to gain more confidence in the baseline scenario, we will adjust the degree of monetary easing as needed to ensure the achievement of the sustainable 2% inflation target.
Governor Ueda there. I'm joined now by Mary Nicola, Bloomberg Markets Live strategist in Singapore. And there's a lot to keep track of when it comes to the Japanese conversation in the last just few hours, in fact. Can you take us through the latest news lines? We've heard from Governor Ueda, but we've also heard these comments from the Ministry of Finance around consultation with the market. What do we need to take away from this conversation? Because it seems to be bringing global yields down.
Yeah, we have to remember that over the last few days, that Japanese yields have really suffered, and Japanese bonds have really suffered on the back of the fact that you had a very weak auction last week for the 20-year. So the long-dated bonds have been under pressure, and largely to do with the fact that we have seen long-dated bonds in the U.S. have also been under pressure, is suggesting that there is a broader concern about fiscal largesse from countries that do have large amounts of debt. So what we've now seen is that the the MOF is now considering tweaking some of the issuance plans, which is a welcome reprieve for Japanese bonds. And of course, ahead of, there was expected to be a 40-year debt auction this week. And of course, there was a lot of nerves going in of what to expect given the underperformance of the 20-year last week. So I think this is great welcome news for a lot of Japanese bond investors, and it will likely ripple through, which we are already starting to see, through other bond markets as well.
Yeah, we certainly see it having some impact at the longer end of the US curve, or even if slightly limited. Mary, yes, and you're right to point out, of course, that 40-year auction that's planned in Japan. We'll know the results of that around this time yesterday, so a lot of focus on that even in this region. Let me ask you about what's going on in FX markets then as a result of that, because I mentioned earlier that we had seen strength in the yen and weakness in the dollar. That seems to have abated, maybe to do with some of that conversation around the long end of the Japanese yield curve. But what are you seeing in FX markets right now? A bit of dollar strength actually creeping in this morning.
Yeah, it's interesting because when we came in on Asia hours, it was more or less broad dollar weakness, and that was really the clear message, especially because you didn't see much of a movement in equities, and it was really about the dollar and the underlying dollar pressures. And that's really not going to go away anytime soon. You still have policy uncertainty. We had the policy whiplash on Friday, and then we come in on Monday with a complete reversal. So the underlying tones that is likely to impact the dollar has not gone away. So what you are going to see, especially coming back in, is sure, you could see bits of reprieve for the dollar, but the underlying tone and the trajectory of the dollar is still for weakness, given what we've seen on both trade policy and, of course, let's not forget, we still have the fiscal talks fiscal talks in the Senate, and that's underway, and that's likely to add pressure on the dollar.
OK, yes, absolutely. We continue to watch it then with interest. Mary, thank you very much. Bloomberg Markets Live strategist Mary Nicola. Now, we talked a lot already about trade tensions on this programme. Let's go to that theme. The EU says it will accelerate negotiations with the US to avoid a transatlantic trade war, days after President Trump criticised the bloc for taking advantage of the US and slow-walking talks. That's his view, of course. We're joined now by Bloomberg's Oliver Crook, who's in Berlin. Ollie, good morning. So talk us through the EU's response, because we heard from Ursula von der Leyen, I think, late Sunday, and then sort of reiterated yesterday an eagerness to move things forward more quickly.
Yeah, this is really an attempt to sort of breathe some momentum back into these discussions after that 50% tariff threat by Donald Trump on Friday that was supposed to kick in next Sunday, which has now been delayed until July the 9th, giving a little bit more runway to get more alignment between the United States and the EU, which they have so far failed to do. We understand that Maros Sefcovic, the EU Trade Commissioner, did speak yesterday with Howard Lutnick and Jameson Greer, the U.S. Trade Representative, saying that the EU Commission remains fully committed to constructive and focused efforts at pace towards a deal. We continue to stay in constant contact. The EU Commission, for its part, said that now the EU and the U.S. were on a sort of fast track to get a deal. I'm not entirely sure what a fast track actually means. This may be sort of more rhetorical than real. To this point, there has been an absence of a sort of document or a framework where I think that anyone has really been able to sink their teeth into. We know that the EU is really aiming longer term to get to 0 for 0 with the United States. That means 0% tariffs for 0% tariffs. I think it is fairly clear that the Trump administration, even in a sort of the best and the most optimistic deal, has no interest in sort of in a 0 for 0 situation. What I think is interesting is, of course, the great difficulty and the complexity with the Trump administration in these negotiations is the fact that they're sort of cross-contaminating policy issues. We still hear repeatedly from the Trump administration saying how unhappy they are with the EU, the way that they tax, for example, digital services. They go after U.S. tech companies. That is not something that the EU would commit to not doing, for example, in a trade negotiation, nor is it the trade representatives from the EU's prerogative to do those sorts of things. So again, the conversations are still ongoing. We do not yet have a framework, I think, that is at all sort of satisfactory to the United States or the EU. We should say, though, we got this from Bloomberg Economics of what the impact of 50% tariffs would be on the U.S. economy. According to our calculations, it would reduce GDP by almost half of 1 percentage point, 0.6%, and it would boost inflation by 0.3%. So there is an incentive on both sides to get this deal done. Whether or not we get the framework will have to materialize over the next couple of weeks.
Yeah, and what kind of detail would there be in any deal? We'll see. You talk about zero for zero. It does seem as if the two sides talking past each other to some extent, doesn't it, Ollie, with the US, as you say, focus on those non-tariff barriers, trying to have national conversations with that in mind. Let's move things on to other geographies, though, when it comes to trade. Chinese and EU trade heads are going to be meeting in early June. Of course, it hasn't all been smooth sailing on that in that geography as well. What will be the impact of those conversations?
Yeah, I think that's fair to say. But Maros Sefcovic, of course, has probably got the most busy job right now in the EU Commission, and he will be meeting with his counterpart, the Chinese Commerce Secretary, in Paris in June on the sidelines of a WTO meeting that will be taking place there. And again, it comes at an interesting time for the sort of EU and the Europeans. We also will have one of the highest level meetings between EU leaders. They're all going to China at some point in July. We don't have yet the dates there. But in the context of the erratic trade policy out of the United States, both the EU and China are trying to cast themselves as reliable, stable partners within the world, particularly on trade and a number of different issues. So far, there has been a sort of limited appetite here in Europe to get any kind of rapprochement or any wholesale kind of reconfiguring of the relationship between the EU and China, though, of course, we have heard repeated calls for that from the Spanish, for example. And could that change as time goes on? I think, it's very difficult to say. If the EU feels that it can sort of address some of the issues, some of the other concerns that they have over China in terms of their industrial strategy, could you ultimately, in the face of an erratic Trump administration with all of these sort of threats of tariffs, see a bit of a rapprochement between the two? That is certainly possible. Right now, I would say it seems unlikely. But again, when you have more and more of these contacts between the trade representatives of the Europeans and the Chinese, and again, this EU leaders meeting in July, things could certainly accelerate, particularly if the situation in the United States does not improve.
Ollie, thanks very much. Bloomberg's Oliver Crook with the latest on those trade stories as they develop. Let's talk about the auto sector, often the focus of trade conversations, of course. Well, European car sales dropped in April amid weaker economic growth and uncertainty due to global trade tensions that prompted consumers to hold off on larger purchases. Bloomberg's Danny Lee has been poring over the details, and he can break down the numbers for us. Danny, good morning to you. I see that we've seen a drop in sales at the overall level in a number of big economies in Europe.
Yeah, I mean, it's not good news, Anna. Good morning. So what we can see in the data is that there is weakness for the third time in 4 months that we are seeing a contraction across Europe. That's according to Europe's auto industry body. This time it was a 0.3% decline to 1.08 million. And as you said, the way you see the drawbacks, it's the likes of the big car markets in Europe, the UK, Germany and France, all seeing a contraction. And then when you broaden it out into some of the kind of types of vehicles, we continue to see this accelerating decline in gasoline and diesel cars. And despite the fact that there has been a surge in EV sales across Europe, not enough to make up for that decline. So there is that weakness. But as you said, there is that backdrop of the concerns for consumers, given the US tariff concerns, and also that weak economic backdrop, which is kind of complicating the picture for automakers and their consumers purchasing.
And we know that Tesla has had a tough time in Europe in recent reports, and so we were on the lookout for more of the same, and I think we got that, Danny.
Yeah, as you said, Tesla sales halving in April to 7,200. And, given this April period was a kind of watershed moment, the fact that it was overtaken in sales according to some private market research data by China's BYD, and then one of the big threats to someone like Tesla. And so by seeing Tesla being overtaken, it is quite a moment to be seen. And Elon Musk had been defending Tesla's sales performance last week in an interview with Bloomberg, saying it wasn't just Tesla in isolation, but the data does say otherwise. That is Tesla, which is really suffering compared to some of the big automakers across Europe.
And we are seeing that there is a pickup of electric vehicle sales. So they are lower than expected, but they are higher. So fully electric models rose by 28%, but lower than had been more widely anticipated. And that's created headaches for many of the European manufacturers, Danny. Volvo Cars out in the last 24 hours with an update on their prospects. What did they say?
Yeah, I mean, it's just take you back to the broader backdrop here, it's just a challenge in Europe of sales, and then when they're having to confront weakness in big car markets such as China, and also that emerging challenge in the US on tariffs. But for Volvo, they've really had a really quite shocking time. The latest news is that they are cutting 3,000 jobs, so that's around 7% of the global workforce, out of a total of 44,000 employees that it has. And this is its response to try and preserve profitability, to defend against weaker consumer demand, and also just that US tariff threat, of which it is highly exposed to the higher costs of which it exports a lot of cars to the US. So it's trying to grapple with a lot of things, headwinds, and especially the fact it's got new management. But the cost for Volvo is 1.5 billion Swedish krona. But this is all part of a broader 18 billion Swedish krona restructuring that management is trying to confront in order for Volvo to try and stay competitive.
Danny, thanks very much. Bloomberg's Danny Lee with the latest on the autos sector from a number of angles. Let us tell you what is coming up in terms of the trading day ahead and some of the data points we're watching for. At 7 o'clock UK time, in around 45 minutes' time, we'll get the German GfK consumer confidence number. 7:45 UK time, we'll have French May inflation data. Really interesting to watch that number, because actually the French number is looking pretty low for the Eurozone, certainly, given the success, I suppose, in bringing down inflation across the Eurozone. So we are expecting that number for French CPI to come in at just 0.9% year on year, which, when you think about where we've been in terms of the inflation narrative, is not bad. All four top economies could have inflation below 2% in this week's readings. So we're looking out for that confirmation of having got to below 2% on the inflation front in the Eurozone. And 3 p.m. UK time, we'll get US durable goods. We'll also get the consumer confidence number from the Conference Board, and both of those could be interesting. Of course, PCE is the key piece of data for Friday. Look for durable goods to be very influenced by the volatile schedule of deliveries that, of course, we see in the aircraft sector. So aircraft deliveries have been pretty volatile, so we'll watch for that to have a bit of a downward impact. And trade uncertainty, of course, plays in there. Consumer confidence, that could be a better number, though. We could get some better data on that front because, of course, at the time when they were taking these soundings on the US consumer, we had that pullback from the edge, if you like, from the abyss when it comes to US-Chinese trade. And so that could be in the minds of consumers as they filled in or as they responded to this confidence survey. Coming up on the programme, Beijing draws up plans to further boost its manufacturing might with a new Made in China campaign, even as President Trump seeks to bring more factories back to the United States. We'll bring you the details next. This is Bloomberg.
Earnings season is here.
European earnings season in full swing.
They're coming left, right, and centre.
It is the earnings season that is dictating the narrative.
Bloomberg is first to break the numbers.
The banking sector, that's the auto sector, HSBC, BBVA, BNP Paribas,
Continental, Ferrari, all of them really delivering.
With the smartest insights.
I think the rebound that we have seen has been surprising.
The results hit another record high.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back. This is Bloomberg Daybreak Europe this Tuesday morning. Let us turn our attention to Chinese growth plans. The Chinese government is considering a new version of its Made in China campaign to boost production of high-end goods, prioritising technology, including chip-making equipment. Let's bring in our China correspondent, Min Lo, in Hong Kong. Min, nice to have you on the programme. So talk us through this new version of the Made in China plan.
Yes, the Made in China 2025 plan was first introduced in 2015. So by the end of 2025, it's coming to an end. And we understand from sources that policymakers are looking at a new iteration of this, another sort of 10-year roadmap to look at China's strategic priorities. And it's likely to focus once again on high-end manufacturing. As you said, those chip-making equipment will be in focus, especially given the tech curbs from the United States that had put some sort of bottleneck on China's high-end sort of chips development plans, and also posing possibly a sort of national security risk to China. And this is, in some ways, China again pushing ahead with its strategy of relying on manufacturing to push growth and to create jobs, really going against what the U.S. has been calling for, that rebalancing of China's economy. And this is despite Chinese policymakers acknowledging that they do, in fact, need to boost domestic consumption. And we understand from sources that there is a debate among policymakers now about whether to set a target when it comes to consumption's share of the GDP. But they're leaning for now towards a no, not willing to commit to a number, given there is concern that China may not actually have sufficient sort of policy levers to boost consumption in a big way. And that's why they are leaning back on this tried and tested strategy of relying on manufacturing to try to drive their long-term growth.
Meanwhile, we're watching we're watching preparations for Europe and Chinese trade officials to meet in early June. Min, we heard from Oliver Crook a little earlier on, suggesting that both sides were wanting to flex their free trade credentials. What are we looking for from a Chinese perspective?
Yes, I mean, of course, China has been ramping up efforts to shore up its ties with other countries beyond the U.S. as a way to deal with the impact of those trade tariffs. And this is going to be the third sort of engagement that we know is going to publicly happen between the EU and China. The Chinese Commerce Minister Wang Wentao traveling to Paris in early June on the sidelines of the WTO meeting to meet with its European counterparts. So this is an opportunity for both sides to get to know how they will each be dealing with U.S. tariffs, because it's coming ahead of that July 9th deadline when the U.S. has threatened to escalate reciprocal tariffs on EU goods to 50%. It's also coming just ahead of that potential meeting with EU travelers planning to take a visit to China, to Beijing in July. So this could be a meeting where both sides pave the way for potential concrete deliverables in that in-person summit in Beijing. We want to look out for whether they would consider picking up discussions for an investment pact that had been put on ice for many years, or perhaps discussing the lowering of tariffs on Chinese EVs in exchange for price commitments from Chinese companies. So these are things to look out for as both sides look to, as the EU in particular try to play this balancing act between US and China, as US has threatened the EU as well not to lean too closely with China.
OK, Min, thank you very much. Bloomberg's Min Lo with the latest on China's growth plans and what that means for the rest of the world. Coming up on the programme, UK food inflation hits its highest level in a year as grocers wrestle with higher operating costs. We'll bring you more on that and our other stories next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now let's get to some of the other stories that are making news this morning. A car has ploughed into a crowd celebrating Liverpool's Premier League victory, seriously injuring a child and an adult and sending more than 24 people to hospital. The crash created chaos at the end of a day in which hundreds of thousands of fans had gathered for a parade through the centre of the city. Police say a 53-year-old British man has been arrested. UK food inflation has nudged to the highest level in a year this month as British supermarkets battle higher operating costs stemming from the government's revenue-raising budget. According to the British Retail Consortium, food inflation rose for a fourth consecutive month to 2.8%, up from 2.6% in April. Fresh goods were the main driver. And Canada's head of state, King Charles, has arrived in the country to open Parliament there at the invitation of the new Prime Minister, Mark Carney. The move is seen as sending a message to US President Donald Trump about Canada's sovereignty. King Charles will read a speech today outlining the priorities of the new Canadian administration. Coming up on the programme, German Chancellor Friedrich Merz raises the pressure on Moscow as he gives Ukraine the green light to strike targets deep inside Russian territory. This brings the German stance more into line with the UK and the United States. So we'll get an update on the latest, what this means for Ukraine and its ability to defend itself and to hit targets, military targets within Russia. More on that next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Anna Edwards in London, and these are the stories that set your agenda. US stocks set for gains at the open as investors look for signs of optimism in trade relations. The UK market also reopens after yesterday's holiday. President Trump delays his 50% tariff on EU imports until July. The Commission says there's now a, quote, new impetus for the negotiations. Plus, Germany's Chancellor gives Ukraine permission to use weapons to strike deep inside Russia, bringing it into line with the US and the United Kingdom. Let's have a quick check of the markets then. 6:30 here in London. So an hour and a half until we get to European equity trading. And it could be a pretty cloudy picture for Europe. We'll watch what's going on with bond markets closely. But in terms of the inputs that we're dealing with for the European session, of course, the London market will be playing catch up with yesterday's positive risk-on theme. We saw that play out across the rest of Europe in yesterday's session. And so we see FTSE 100 futures up by 0.8%. Euro Stoxx 50 futures more broadly, though, could be range-bound or a little bit of downside, perhaps, as a result of already pricing in some of that positivity, stepping away from the 50% tariff, speeding up EU-US trade conversations. That takes us on to the US session. Also, those markets were closed yesterday, and so we see risk on as a result of pricing in some of that dynamic around trade that markets in Europe moved on yesterday. I'll add into that, though, the fact that we're now seeing long-end bond yields coming down just a little on Treasuries, more so in Japan, but that is coming across into Treasuries just a little. We'll watch what happens in an hour's time at the European Open, but all of that downside move in yields could be interesting, could provide some catalyst for stocks. We'll see if that's the market's interpretation. But this is what we have across a number of assets this morning then. The US 30-year yield, as I say, the long end of that curve, down by 7 basis points now, as a result partly of what's going on in Japan, where we see the 20-year yield down by 17 basis points. And it's interesting, it's the 20, 30 and 40-year yield in Japan where we're seeing those yields coming down quite substantially as we gear up for this 40-year auction and as we take note, essentially, of what the Ministry of Finance is doing, consulting on issuance around the market. So a sense of comfort coming through, perhaps, from that consultation. Let's go to a conversation then with Mark Cudmore, Bloomberg Markets Live executive editor, who joins us now. And let's start with Japan and the signals we're getting from the long end of the Japanese curve, Mark. It seems that the market is taking some comfort from that MOF, Ministry of Finance, consultation with markets. What do you take away from that?
I think the extreme kind of overreaction and short-term price action here to what isn't a particularly stunning development, just a bit of a consultation whether they should trim long-end bond issuance. The fact that we're seeing yields move by almost 20 basis points at the long end of this is just kind of showing how nervous this bond market is, how poor the liquidity is. And I don't think it's a particularly healthy sign for the bond market. It does suggest that the market has got over its skis a little bit on some of these kind of short bond views. And so therefore the rally could continue a little bit further from here. And of course, if the 40-year auction goes well, then people are going to be happy about that. But I think that even though we might see some bonds rally a bit further in the short term, the fact is this is a market, not just JGBs, but globally. But JGBs have an inflation problem. They have a central bank that's still planning to raise rates. They have a market that's getting increasingly concerned about this large debt overhang globally. And so I think that overall, I think JGBs will suffer again in the weeks and months ahead. And this is just a short-term reprieve. It might be a short-term reprieve that lasts several days or even a couple of weeks, but it is not a long-term turning point.
Yeah, that's interesting. So even if it might provide something of a risk-on signal, maybe not so much if you think about the underlying vulnerability then that it reflects, as you point out. Mark, let's stick with the FX markets, though, and pivot to Europe, because we've heard from the ECB's president, Christine Lagarde, who says that Donald Trump's trade policies offer a, quote, prime opportunity to strengthen the euro's international role. Let's take a listen.
Today, I think there is a key difference compared with previous eras. With the euro as the world's second largest currency, there is another international currency alongside the dollar. Europe has many of the key ingredients for success, but they need to be brought together in order to reinforce the foundations. So action is in order.
So the ECB's Christine Lagarde there, Mark, setting this up as an opportunity for the euro, going back to the 1970s, quoting the Nixon shock and the step away from the gold standard and saying how things are so much different now. The world has an alternative to dollars, perhaps in the way that it didn't used to. How did you respond, perhaps, to this sort of long-term thinking from the ECB?
Well, I think she made some valid points. It was surprising kind of how far she went in her kind of criticism of what's happening on policies on the US side at the moment. But I also think we need to kind of temper some of the message. The euro is not going to replace the dollar as the world's reserve currency anytime soon. It would take something truly cataclysmic to remove the US dollar as the world's reserve currency. It is so deeply embedded in our trading system absolutely everywhere. It's not that such a cataclysmic situation couldn't happen, but it will take a much bigger shock than anything we've seen so far under this administration. And even if we get a bond market panic, for example, that will not end the dollar's role as the world's reserve currency. What will happen, though, is greater diversification. The world is still overexposed to the dollar, and they want to diversify further. So as of the end of last year, the US dollar's percentage of global reserves was 57.8%. I expect over the coming years that'll drop below 50%. It'll still be by far the most dominant currency in world reserves. It's just going to have a smaller kind of share of dominance. So there is a de-dollarization theme. That is true. That's been going on for many years. It'll continue. It'll probably accelerate a little bit. But it's not about the end of the dollar as the world's reserve currency. It's just about a declining role of its dominance.
OK, thanks very much. Bloomberg Markets Live Executive Editor Mark Cudmore with us to talk about FX markets. Let's move on to think about commodities. OPEC Plus is bringing forward its video conference meeting to decide July output for 8 key members. The subgroup held talks last week on making another bumper output increase. The third consecutive hike of about 411,000 barrels a day is set to be finalised during the call. For more, let's bring in Dan Merz in Beijing. Talk us through the significance of this, Dan. Is there any significance to the very slight change in date here?
We don't think so. We think this is really just an honest scheduling thing to make the meeting easier for the members to attend. As far as we're hearing, the market is still expecting the same, increase in output that it's been suspecting for the last couple of weeks. So really the question is going to be, this increase keeps coming. OPEC is pretty clearly putting its cards out there that it wants to put pressure on the scofflaws within its own group, on getting its market share back after giving up some of these market gains to other producers for the last couple of years, and it doesn't mind giving a little bit of a lower oil price to help its relationship with Donald Trump. And the real question then is going to be, when we get into the middle of the summer, is there going to be enough demand to sop up the supply? With continued tariff troubles going on around the world, will the economy kind of pick up and give these producers a little bit of a bigger market to sell into so that we don't see prices tank further?
OK, thanks very much to Dan. Thanks to Dan Merz for bringing us an update on the OPEC story. So not much significance then, it seems, to the change in date, but interesting to watch what OPEC Plus decides nonetheless, given the recent dynamics in oil prices. 64.37 is where we trade on Brent. Let's move our attention to what's happening in Ukraine. Chancellor Friedrich Merz says that Germany is no longer imposing range restrictions on weapons supplied to Ukraine, bringing it into line with the US and the UK. It comes as Kyiv's Western allies attempt to intensify pressure on Russia after it launched its biggest drone barrage against Ukraine since the full-scale invasion over 3 years ago. For more, we're joined by Bloomberg senior editor Bill Ferries with details on this. So take us through what it is we've heard from Germany then, Bill, and the extent to which this does bring Germany into line with what we've heard from the United States on ATACMS and the UK on the weaponry that it supplies.
Yeah, so Chancellor Merz's statement, he actually said that there are no range restrictions on the use of essentially Western weapons against Russia. So this has been something that Ukrainian President Zelensky has been asking for years now at this point. He's wanted the ability to hit deep into Russia, to go after weapons storage depots, oil and fuel depots, things like that, things that hit Russia long before they can get their troops or equipment or supplies onto the battlefield within Ukraine. So this really puts Merz more in a position with the U.S., which has allowed its Army tactical missile systems to hit some of the border regions within Russia, and also the UK, which has allowed its Storm Shadow cruise missiles to go into Russian territory. Now, if Merz is right in that there are really no restrictions at all, that will be potentially a big benefit to Ukraine if it has adequate supplies of these weapons to take that fight into Russia? That's going to be a big question. Another question is just going to be, why did it take the NATO alliance and the European partners so long to come around to this position? It is something that Zelensky has wanted since the early days of the war. There's been this repeated conflict between Zelensky's request for things like F-16 fighters that could help dominate the airspace and the reluctance by the U.S. and its NATO partners to provide that. This seems to be another iteration of that, but it could help Zelensky. It will also likely get huge pushback from Russia, which has said the use of these weapons on their territory will only widen the conflict.
Yes, and interesting to think about the U.S. positioning on this then, Bill, because this comes at a time when Europe is stepping up its sanctions package. There is a lot of talk amongst some Republicans in the United States about stepping up sanctions. And we have actually at the weekend, we saw criticism by President Trump of Vladimir Putin, which, of course, is fairly rare. Does this change at all the U.S. positioning around Russia?
Well, we have seen a lot of frustration on the part of President Trump and particularly among those Republicans who are still very much pro-Ukraine. We haven't seen the administration's position change in terms of saying they will enact sanctions, they will send more weapons to Ukraine, or that they would even consider an additional aid package. So while Trump has signaled his anger at the latest barrage of attacks by Russia, we haven't seen them do anything on the policy front that would really be a threat to Putin and his war in Ukraine at this point. We'll have to see if that happens in the coming days. President Trump has been very reluctant to do more than step up the rhetoric so far.
Yes, and we are watching how NATO responds to the latest threat from Russia as well then, Bill, and that is a pressure point that the United States has been keen to push on. We've heard from Mark Rutte that there is ongoing talk about a 5% of GDP spending target for defence. It's not all military spending necessarily. It could be military adjacent. But what's the latest on that?
Yeah, when actually President Donald Trump kind of floated that target earlier this year, and it was seen as kind of wildly unrealistic that European nations would hit a 5% of GDP defense spending target. Now that seems to be in play. The mix would be between the hardware, personnel, and then things like military infrastructure. I think however they get there, it would be seen as a positive by the United States. Remember, the United States does not spend 5% of its GDP on defense. So this would be a big statement if they can get the NATO bloc to agree to it. And it would put the pressure on Donald Trump to perhaps align himself a little more closely again with NATO.
Bill, thanks very much. Bloomberg senior editor Bill Ferries. Coming up on the programme, Mark Zuckerberg has been doing everything to win over the US president. But how much does the Meta CEO have to show for it? We will dig into that story. That's coming up next. This is Bloomberg.
Earnings season is here.
European earnings season in full swing.
They're coming left, right, and centre.
It is the earnings season that is dictating the narrative.
Bloomberg is first to break the numbers.
The banking sector, that is the auto sector, HSBC, BBVA, BNP Paribas,
Continental, Ferrari.
All of them really delivering.
With the smartest insights.
I think the rebound that we have seen has been surprising.
The results hit another record high.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back. This is Bloomberg Daybreak Europe, 6:46 here in London. Now to our big take story. Meta CEO Mark Zuckerberg has taken a hard turn towards the Trump administration. But will embracing the MAGA movement help or hurt the social media company? That's the subject of today's big take story. And Charlie Wells is here to discuss it and to give us the details. Charlie, very good morning to you. So how are we seeing Mark Zuckerberg then? How are we seeing his political strategy evolve?
we're seeing it evolve in a very extreme way, especially if you sort of rewind back even to as recently as, say, 2017, which I think we all remember when the kind of chattering classes out of D.C. in the media, in politics, were talking about Zuckerberg as maybe even running for president as a Democrat. And now we are seeing him really get close to the Trump administration. Meta donated $1 million to the inauguration. Mark Zuckerberg hosted a black tie event for Donald Trump. We've seen a lot of kind of Trumpification of policies within Meta, so dismantling of a civil rights group there, of getting rid of outside content moderators, weakening hate speech rules at the company. And so this is a really, really dramatic turnaround from that point in 2017, and even from the point, say, during the Obama era, when we saw a lot of engagement between Mark Zuckerberg, between Facebook, and the Obama era. And now we're seeing a similar type of engagement, but with Trump, very different politically.
OK, so different politically, and embraced then by Meta and Zuckerberg of the MAGA movement, perhaps. But what are the risks then for Meta in this approach?
There are some really big risks here. And I think one of the concerns is that, you know, by trying to please Trump, you actually really alienate the sort of left-wing kind of user base. You know, there's been this kind of long view that Silicon Valley is, you know, kind of more left-leaning. Whether or not that's true, I think, is up for debate. But you alienate the users on that front. You alienate workers at Meta who, you know, some of them have very kind of left-leaning political views. Some of them have right-leaning political views. But then the concern is that the strategy doesn't work. That, you know, Trump himself has spent nearly a decade using Meta, using Facebook as something of a punching bag. So you've created this kind of, you know, enemy. It's really hard to kind of shift the move there so that you kind of end up just alienating everybody.
Right, OK, so that's the risk, but they must be doing it hoping for some benefit. So what could the upside be for Meta here?
Yeah, and I think that gets at a really important point, which is that there is strategy behind this. And I think with a lot of kind of, you know, corporate actions in the Trump age, it's a lot of like what doesn't happen. It's what CEOs are trying to avoid. And I think some of this could be Meta, it could be Zuckerberg trying to avoid getting targeted by some sort of, you know, retaliatory move from the Trump administration if they make some kind of policy, if they make some kind of product that the Trump administration doesn't like. But this also could be, you know, an attempt to kind of change some of the tech regulation that we've seen in the United States. And we also know that Zuckerberg and Biden did not have a close relationship. They never met personally. We know that the Biden administration really took a kind of negative view of the tech industry. And so there could be a strategic move here to try to kind of soften a lot of that hard stance the prior administration took. OK,
really interesting developments there in terms of the politics in Silicon Valley. Let's think about what we've heard recently from the Trump administration via the US tax bill and what that means for businesses such as Meta. A lot of our coverage focused, of course, on the fiscal implications of the tax bill. But there are, for specific sectors, really interesting provisions here. The tax bill passed by the House, it's given the inclusion of provision targeting digital services taxes. Now, unpack this for me, Charlie, and help me understand.
Super interesting here. So this is Section 899, and this is in that bill that just passed the House last week. And this is something that Meta would like. And you could maybe see it as something of a legislative win. I mean, you know, the bill is not law yet. It's still passing through Congress. But basically, this would increase federal taxes on passive income earned by individuals and by investors in the United States from countries that have kind of what the U.S. would deem unfair tax regimes on the United States. So potentially included in this would be that UK digital services tax. It's that 2% levy on large search engines, on social media companies for the revenue generated by users in that country. And this is something that the Trump administration does not like. They see it as unfair. So this could be something that they are targeting here. This could be something that Facebook really likes. But also the rules would dictate that the U.S. would have to name the countries with these so-called unfair tax regimes. And so that could give some negotiating leverage, some negotiating time, at least, for, say, the UK to deal with this.
OK, Charlie, thank you very much. Charlie Wells with the latest on our big take story. You can, of course, read the full story on the Bloomberg terminal or on the Bloomberg website. Now, for some of our other stories making news today, US prosecutors have demanded that Builder AI hand over financial statements and other documents, signalling that the artificial intelligence company was facing legal scrutiny in the weeks before it went bust. Bloomberg reported last week that the startup had overestimated sales by as much as 300% in a report to creditors. Sources have told the Financial Times that Trump Media and Technology Group plans to raise $3 billion to spend on cryptocurrencies. The move could be announced ahead of a meeting of crypto investors in Las Vegas this week, where the FT reports Vice President J.D. Vance and Donald Jr. and Eric Trump are expected to speak. And President Trump has threatened to divert $3 billion in grant money from Harvard University to trade schools across the United States, citing the university's alleged anti-Semitism. His administration has already frozen funding and blocked international student enrollment as it pressures the Ivy League college for policy changes. Harvard has resisted the demands, winning a temporary court order blocking the ban on foreign students. Plenty more coming up on the programme. We'll continue to monitor what's happening at the long end of global bond markets. US futures pointing higher on trade optimism as well. More on the markets shortly. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. The time is 6:54 here in London, so just over an hour until we see the start of European equity trading. One of the things we're tracking very carefully this morning is the long end of the bond markets in various geographies, but Japan seems to be the driving force here. We are seeing the stories out of Japan having a bit of a downward influence on yields out of the United States as well. But this is the longer-term picture around Japan. So Japanese bond yields are retreating from records, and you can see the ramp up there on the right-hand side of this chart. We are retreating from those levels. Is that a good, maybe seen as a good sign? We heard cautious words from Mark Cudmore earlier on, though, saying it just sort of underscores the vulnerability that there is around the JGB market. The fact that the Ministry of Finance just going out into the market and consulting with participants can have such an impact on long-end bond yields. But that's one thing we're watching. I want to also focus in on another interesting story, and this is going to be deeply buried perhaps in the consumer confidence data later on. One of the things they tap into there is whether Americans expect to earn more or less in 6 months' time. And mostly Americans, their usual position is they expect to earn more in 6 months' time. But we do see on the far side of this chart, very small, but if you squint, you might just see it, that actually the last reading we got here was Americans expecting pay to drop. And that is unusual. It doesn't happen very often. If we see that coming through again in the consumer confidence data, that could be interesting. But it might not, because, of course, we heard that about face on trade policy with China. And a quick word on the earnings story, because we're going to get numbers from Nvidia tomorrow. So this is going to be a focus for us over the next 48 hours or so. And just a reminder of the one-day change in market cap that it is possible to see around Nvidia. Just last time, February 2025, $272 billion erased from the market cap of this giant of the AI space. That just a reminder of what's at stake when it comes to global equity markets and the Nvidia earnings story. Don't miss our exclusive conversation later with the Richmond Fed President Thomas Barkin. That is at 2:30 p.m. UK time. Will patience and sitting on our hands be the themes we continue to hear from the Fed as they wait for clues around the US economy? The opening trade is, of course, up next. This is Bloomberg.